Professional enablers and financial gatekeepers. Professional enablers like lawyers and accountants are vital to economies, but their expertise can be misused to enable financial crimes. Their knowledge and access to financial systems can sometimes facilitate money laundering, corruption, and sanctions evasion. Gatekeepers play crucial roles at the intersection of clients and the financial system, acting as the first line of defense. Weak due diligence or declining ethical standards can lead these actors to inadvertently or deliberately support criminal schemes. Conflicts of interest and misaligned incentives are significant factors that can undermine the integrity of financial gatekeepers. This section explores the misuse of enablers, focusing on structural vulnerabilities and the standards in FATF Recommendations 22 and 23. Abuse of claims to legal privilege and confidentiality. While legal privilege is a key safeguard for legal advice, problems arise when it is claimed beyond its proper scope for commercial activities. In these cases, privilege can be used unfairly to block disclosures and delay regulatory activities and investigations. Overbroad claims restrict access to key documents and transaction details, creating gaps that delay critical risk assessments. These delays increase the risk of asset dissipation and loss of evidence before authorities can effectively intervene. Ongoing resistance to transparency and frequent reliance on privilege without a clear legal basis are considered high-risk signals. Successful mitigation relies on distinguishing protected communications from business activities to maintain the integrity of financial systems. Accountants, auditors, and financial statement legitimization. Accountants and auditors play a vital gatekeeping role by verifying financial statements, tax disclosures, and corporate records. However, when independence is compromised, accounting outputs can be exploited to falsely legitimize illegal financial activities and hide fraud. Criminals might attempt to modify bookkeeping entries or justify discrepancies using complex and opaque accounting methods. Achieving unqualified audit opinions for illegal funds creates a systemic risk, undermining transparency across investment and regulatory sectors. Behavioral signs like aggressive accounting methods or unexplained restatements warrant closer attention from financial institutions. Successful detection relies on professional skepticism and thorough due diligence, ensuring legitimate reporting doesn't become a channel for crime. Use of corporate secretaries and nominee directors. Using corporate secretaries and nominee directors creates a layer of opacity often seen in financial crime and sanctions risk cases. While these roles have legitimate purposes, they can be exploited to hide the actual controllers from official ownership and decision-making records. By involving professional intermediaries as directors, those trying to conceal control can reduce transparency for regulators and financial institutions. Nominee arrangements often create profiles that look procedurally compliant, but lack clear economic transparency across different jurisdictions. Mismatches between corporate roles and economic activities require further investigation into control relationships and transactional behaviors. Cross-border professional networks and regulatory arbitrage. Cross-border networks provide essential services globally, but can be exploited to take advantage of differences in regulatory strictness. This regulatory arbitrage uses gaps between regimes to lower transparency and make enforcement more difficult. The division of services across countries can hide a comprehensive view of ownership, where legal, financial, and operational tasks are split. While each part may seem compliant alone, the full picture can hide beneficial ownership links without integrated oversight. Effective mitigation relies on international cooperation and mechanisms for sharing information among supervisory agencies. Institutions must scrutinize complex structures, emphasizing economic rationale and spotting structural features without credible commercial reasons. Ethical failures, willful ignorance, and complicity. Commercial incentives and client pressures can impair judgment, undermining commitment to ethical and regulatory standards. Willful blindness involves consciously avoiding obvious risk signs, such as failing to investigate suspicious transactions or ignoring inconsistencies. Active complicity means intentionally participating in concealing or legitimizing illegal activities, such as manipulating financial records. Both behaviors weaken AML systems, which depend on professional skepticism, investigative inquiry, and independent verification. Regulatory frameworks are increasingly focusing on accountability, with enforcement actions emphasizing ethical governance and integrity. Fostering a strong compliance culture and maintaining documentation integrity are vital defenses against financial crime and sanctions evasion. Investment advisors, family offices, and wealth managers. Wealth managers operate in a space defined by high-value assets and stringent confidentiality, focusing on portfolio management and asset preservation. The discretion and customization inherent in wealth management can also be exploited to hide, reposition, or integrate illicit wealth. Actors might use family offices and complex fund setups across multiple jurisdictions to hide beneficial ownership and make assets harder to trace. Holdings across multiple jurisdictions can reduce transparency, making it difficult to evaluate the true source of wealth. Regulatory frameworks focus on strict verification of funds and continuous monitoring of shifts in investment behavior. Enhanced due diligence and increased oversight are vital to maintaining market integrity and preventing the misuse of wealth management channels. Lawyers and legal professionals as transactional shields. Legal professionals can serve as transactional shields when their services are misused to lend legitimacy to illicit financial activities. The confidentiality of attorney-client relationships can sometimes hinder transparency when transactions are structured to mimic regular legal tasks. Funds may move through client trust or escrow accounts, using intricate contracts to hide true ownership and mask economic intent. This layering effect results from strategically involving professional intermediaries, decreasing the transparency of the actual flow of value. Regulatory regimes impose AML duties on legal professionals, including due diligence, monitoring, and reporting suspicious transactions. Successful mitigation relies on integrating professional ethics with financial crime controls to prevent legal channels from becoming illicit conduits. Notaries and escrow services as laundering intermediaries. Notaries and escrow providers hold a trusted role, verifying documents and managing settlements in real estate and cross-border deals. While essential for business, this procedural legitimacy can be exploited by illicit actors to hide unlawful transfers within compliant processes. Escrow accounts can be misused as layering tools, allowing funds to pass through reputable intermediaries before reaching final recipients. The outward appearance of regularity can hide irregularities in fund flows, settlement orders, or relationships between parties. Compliance frameworks focus on repeated use of escrow accounts and transaction patterns that don't match the account's purpose. Effective risk management relies on identifying signs of unclear economic substance to maintain the integrity of legally mediated transactions. Real estate professionals and the facilitation of high-value transactions. The real estate sector faces high risks due to large transaction amounts and subjective property prices, making it attractive for hiding illicit funds. Risk exposure rises when accepting third-party payments or using legal entities to buy property, which can hide the true identities of buyers. Cross-border acquisitions and all-cash deals avoid standard lending reviews, making it harder to trace the source of financial activities. Many jurisdictions are expanding AML duties to include real estate agents and developers, emphasizing due diligence and record-keeping. Transactions that don't match a buyer's known financial background or investment purpose should be flagged for closer examination. Effective controls rely on combining sector oversight with AML systems to identify structural red flags rather than just obvious irregularities. Trust and company service providers, TCSPs, and corporate opacity. TCSPs are central to managing legal entities and trusts, facilitating lawful purposes like asset protection and international investments. However, they can also be misused to create complex ownership structures that hide beneficial ownership and control. Using nominee directors and chains of entities across different jurisdictions can hinder efforts to identify ultimate beneficial owners. TCSP services like registered office facilities and management support may unintentionally create more separation between institutions and actual controllers. Financial institutions must examine arrangements with complex layering or frequent use of nominees as high-risk indicators. Effective risk management relies on verifying beneficial ownership and economic substance to ensure transparency within the financial system. Trust and company service providers, TCSPs, and corporate opacity. TCSPs are central to managing legal entities and trusts, facilitating lawful purposes like asset protection and international investments. However, they can also be misused to create complex ownership structures that hide beneficial ownership and control. Using nominee directors and chains of entities across different jurisdictions can hinder efforts to identify ultimate beneficial owners. TCSP services like registered office facilities and management support may unintentionally create more separation between institutions and actual controllers. Financial institutions must examine arrangements with complex layering or frequent use of nominees as high-risk indicators. Effective risk management relies on verifying beneficial ownership and economic substance to ensure transparency within the financial system.
Thank you for watching this lesson. If you found it helpful, please like the video and subscribe for more AML and compliance training. If you would like to earn an anti-money laundering certificate, please visit www.nasiacademy.ca. The first course is free and eligible for certification. I'll see you in the next lesson.